gonna start the recording. Okay, so hi everyone, this is Finance Meets Real Estate. As you guys know, we meet here every Tuesday, 6:30 p.m. Eastern Time. We have an amazing guest here today. It's my friend Don Spafford. So he has a very unique investing strategy, actually. Is for reaching financial independence. That's the topic today. So alternative investment strategies to reach financial independence. So he's investor relations specialist at Happy Camper Capital, and he's going to talk about essentially, well, they're like a campground RV real estate strategy, right? So that's pretty unique in itself because you generate, like in typically commercial real estate, you generate your value by improving the NOI of the property. But now the levers of improving NOI in a campground kind of business are different than the levers in typical multifamily. So that's a more unique alternative strategy. So he's going to talk about that. And so Don has educational background in finance and securities investing. He graduated magna cum laude from the University of Nebraska at Omaha, with 4 majors, including finance, banking, investment science, and portfolio management and accounting. And he has nearly 2 decades of experience in finance and investing. He's married for 21 years. His wife is from Paraguay, and they enjoy visiting family in South America and etc. So he I think like I guess you can tell us more about yourself. I know you have a very, very long resume. So, but overall, I'm really interested to hear like today's topic. Like myself, I find that like this kind of like commercial, like value add, like being able to improve like a business's profitability essentially and raise the valuation of that business in all those less standard fields, even if it's like people who do it with short-term rentals and so forth. And I feel like it has a lot of potential and like to realize how higher equity multiples. So I think it's a very great great thing. So anyways, with that, I'm going to pass it on to you. And so if you guys have any questions, feel free to speak up. We're doing an open conversational format, or if you want to put your questions in the chat, that's fine as well. Yeah.
Okay. All right. Well, thank you, Stefan. Yeah, pleasure to be here. I guess to keep on the topic of the discussion today, so going back a bit, I've been in pursuit of financial independence for a bit of time here, I guess, but it was something that I was not really aware of before. Like I said, with that educational background in finance, investing, and accounting and stuff, in school they don't ever really teach you about investing per se, even though I took investment courses, right? So to be like a portfolio manager or something with that, but they teach you the I guess the standard traditional way of investing your IRA and investing in stocks and whatnot. So I got pretty good at doing that. But around the 2008 market crash, that's kind of when I had my eyes, I guess, opened up that that even doing that route is not necessarily safe, right? There's lots of, and that's not the only case. You think of like the Enron, when Enron collapsed and went bankrupt. I remember at that time seeing on the news when people were like, in their retirement years and crying on a news report that their entire life savings was in Enron stock because they had worked there and retired from there, so their entire portfolio was basically Enron, and that was all gone. And so I was like, wow, that's definitely not the nest egg that I was promised, I guess. For you think about your 401k or IRA, anything that's that's the stock market based. So that's kind of what really got me looking into other options, and that's kind of really how I got into real estate to begin with. Now for me,
sorry to interrupt. So that was 2008 actually when you got into real estate first, or was it later?
No, so when it was a bit later for sure. Yeah. I definitely took advantage of the 2008 market. The market crashed. I bought as many stocks as I could at the time. Didn't have a whole lot in savings myself, just to put into that. But I was like, I got to get something in there, right? So I kind of bought what I could, ones that seemed to make sense, and did pretty good from that. But definitely nothing life changing per se. But it wasn't until around 2010 2010, I guess, when we started even looking into real estate. I did obviously notice that the housing prices had come down in that 2008, 2009. I was like, man, this would be a great time to pick up these houses that were just recently selling for 250, 300,000, or now 70,000. But I was like, I didn't know how. I didn't understand the process. I was myself, like probably most people I think out there, that you think of real estate as it's it's for the wealthy, and that's what they invested. Your average guy can't do that. But so in 2010 ish, somewhere there, my wife actually became a realtor, and with that, one of her very first clients was an investor, is a friend of ours, and he was, so in his case, it was kind of like followed that previous mindset. He was, let's not say wealthy, but he was a lawyer, so he had his own his firm, and he was able to get a line of credit against his business and use that line of credit to purchase properties in cash, and then of course fix them up and refinance them. He was doing the BRRRR process, which back then I had no clue what that was. I just thought it was pretty cool that he was doing that. But again, I was like, well, I don't have a line of credit business to draw from, so I can't do that. But anyway, he's got my mind thinking, and so I picked up a book kind of on accident, the Millionaire Real Estate Investor by Gary Keller. I was not purposely looking for that book. I was actually trying to find the Millionaire Real Estate Agent book for my wife, so her broker recommended that for her. And so when I was searching for that to purchase for her, I saw that other one. I was like, yeah, let's get both of these. So I got her the agent one to read and the investor one for me. And that's kind of my first, I guess, education on understanding real estate investing. But and this was at this time we lived in Omaha, Nebraska, and there was definitely a lot of opportunities. But again, I still didn't know quite how or where I was going to pull the money from to do that. Didn't have a lot of savings or anything to work with. Didn't have a high income paying job, and so it was definitely difficult. We had several little kids at home, so a lot of our expenses were going towards health insurance and food and clothing, all the typical stuff that you'd have with the family expenses, right? So it was hard to save. And
that's like, sorry to interrupt, that's like 2010, 2012, like that kind of period.
Yeah, pretty much in there. As we started going to with my wife to go see more properties, several foreclosures, for example, I was like, man, we gotta figure out how to do this. And so by the time we were trying to get ramped up to decide how we were going to do it, is around the same time we decided we actually needed to move. So we, around 2013, 14, somewhere there, actually 2013 I think it was, we decided we needed to move to Idaho. And the reason for that was for family purposes. So with that, I kind of decided to put everything on hold. I didn't want to end up getting some rental property there in Omaha and then move and have it long distance, not having any clue how to manage it or do anything with it. So I was like, that was too scary. So we put it on hold, waited till we moved here. We moved here to Idaho, where I'm at now, in 2015. And then about maybe a year later is when I started to get back into it. I actually talked to the I guess the mortgage broker that we used to purchase our home here. I asked him, was like, hey, how can I get some investment properties? And he was, of course, like most people or most lenders, I should say, was along that traditional line of 20 to 25% down payment. And I was like, well, that's a lot to come up with, So fast forward a little bit, I ended up going to this local seminar on real estate investing. I think it was more geared towards like house flipping, which of course interested me, but at the same time, I was still not quite what I was wanting to do. Actually, I knew I wanted to get into rental properties. But anyway, so I went to the seminar anyway, just to kind of listen and learn. And I met a guy there that introduced me to Bigger Pockets, and that's kind of where I was like, okay, I've never heard of Bigger Pockets before. So I got in there, fell in love with it like immediately. Started using the calculators and listening to podcasts and webinars, and that really ramped up my education much more quickly. And so with that, I made the decision, okay, I don't want to get single family homes. I wanted to go into multifamily because I realized there's economies of scale with that. But of course, not necessarily the commercial side, but like smaller multifamily. So I was actually searching for fourplexes. I realized, okay, I want to go into fourplexes because that's the most numbers you can get with still a residential loan.
Yes.
And so I started looking. Of course, my wife being a realtor, we had access to MLS. But I was also searching, anything else like Zillow or Craigslist, whatever I could find for anything.
Wait,
And
and that's like again like 2012.
so no, this was now,
That's later.
this
Good.
was early 2017, like January
17.
2017.
Okay, good. Okay.
End of 2016 is when I went to that seminar and found out about Bigger Pockets, but early January 2017 is when I really got involved.
Oh, yeah.
So almost 10 years from that, I guess 2008 crash to this point. But one thing that did help me that I learned, and I found this out on Bigger Pockets, just in the forums and whatnot. I discovered a local lender in my area that will do 10% down payments on investment properties. So I did not need the 20 or 25% down. I could come up with 10%, which is much more easy to come up with. And on top of that, I actually still, not having a lot of savings still, I discovered I could leverage other money I did not even realize that I could use for this, which was my 401k. So I had my retirement account, which most people traditionally will tell you don't touch that. That's your that's your retirement. You leave it alone. But I saw this as the only way I could really get in there and get started and get things moving. But I took a loan against it, so I wasn't withdrawing, so I wasn't paying taxes and fees or anything. It was just a loan, which allowed me to pay it back over 5 years if I wanted to. So I took that 5 years to have less to pay back than minimums, but I was able to pay it back more quickly. But anyway, that was what really got me started. I got this fourplex with like 26,000 down. Part of that, again, most of that I say was from the 401k. The other part, again, go back to those stocks I purchased back in 2008 and 9. I sold some of those for a decent gain to help cover more of that. So pretty much the whole entire down payment was nothing technically out of pocket, or out of my little savings I had. So this was definitely a bit of a risk. Obviously most people would say don't get started investing with real estate unless you have some financial runway. If something happens, if you need some kind of savings there for whatever. I didn't really have that, but I knew that if I needed to, I could take out a second loan for my 401k for absolute emergency. But this was a newer enough property. It was built in like 96. We had visited it. It looks like it's in decent shape, so I wasn't too concerned about any major problems coming up, as long as no tenants destroyed something or something just unexpected happened. So we decided to take the risk. We pushed forward for it. And we got that property, and so we closed on that in June 2017. So that was our very first property. And from the beginning, it was cash flowing around, I'd say 500 a month, more or less. But I knew that it was under market rents, so I was like, I can raise the rents. And I was self-managing it because one, I wanted to save on that cost, and two, I wanted to learn the process to get familiar, since it wasn't too far away from me. And so here we are now, almost such 5 years later from that point. I still self-manage it now because it really takes no time at all. And the other property manager I have spoken to about taking over, they wouldn't want to charge as much rent as I'm charging because they don't think they could get it. I'm like, well, I'm getting it, and then I'm not waiting 2 months to fill them. I'm getting multiple applications each time, like right away. So it's really not that difficult. But they don't want to go through that I guess hassle. So I'm like, well, I'll keep managing it then. Anyway, so I've got that, and so that one now has been cash flowing about $1,200 a month now at this point. But I just recently, this year, actually did this more recent close on this. I just did a cash out refinance on that property. Of course, it's like basically doubled in value since I purchased it in 2017. And so I was able to pull out over $100,000 on it. And so again, I put 26,000 down, and now I pulled out over 110,000. So essentially, obviously, I've got now infinite returns on there. And just of course the cash flows alone have more than paid back that original down payment, but now I've got this extra cash out I took from it, but it still is cash flowing about the same anyway. I'm still around $1,000 per month cash flow on it, so I didn't maximize the most I could take out on the cash out. I wanted to still keep that property cash flowing decently to basically take care of itself, but with that cash out, now I can of course invest into other properties. So again, that was the very first property.
So is this Idaho Falls or like which?
So this is in Pocatello, Idaho. Actually, it's about 45 minutes away.
Okay.
Yeah.
And you're in Idaho Falls, right? Or?
Yes, correct. I'm Idaho Falls. Yeah.
Okay, cool. Okay, so that's where Brian Briscoe moved there, I think. Right?
Yeah, that's right. He lives here now as well.
Neil Bauer invests there, I think, quite a bit.
Yep. That's right. Yep. Okay, Bauer's doing a project here. He spoke to them about this area for some time. Actually, this is one of his favorite areas in the last couple of years. So yeah, it's a great area to be in. So again, that's the property got me started. And like I said, gone go full cycle. I did not, again, I decided not to sell it. I wanted to keep it because it still cash flows well. And I wanted that to, go forward and help with other things going forward. But even when I purchased it, 5 years ago, I had the understanding for me anyway, it was more of, I knew that at some point down the road, when my kids start college or other needs come up, that the cash flow from that property could help pay for those things, right? So it wasn't necessarily just about trying to get rich or whatever. I saw that, okay, that cash flow money can be used for other things other than just my at some point living expenses. But from the very beginning, I never took the idea of using that cash flow to purchase things, right? I just let that money build up. So I wanted to basically recycle that cash and reinvest it into other properties. Because I had, initially back at that point, we soon after we bought that property, we had the van we had, the transmission went out, and it's like, well, now I got to buy a new van because it wasn't worth replacing the transmission on. And so of course we got another user. My friend is like, why not use your cash from your property to go buy a van? I'm like, because that'd be stupid. I'm not going to waste my money on a depreciating car, but.
So let's say because I know you have like kind of like securities and finance background before, right, in other investment strategies. So let's say in this case, so the investment strategies would be okay. For example, the infinite return when you are able to raise the value, either raise the value of the property or because you kind of benefit from very high leverage, I guess, and then kind of like refinance out upon appreciation or upon some kind of the price inefficiency, and so kind of then realize an infinite return, sort of infinite. I mean, from that point on, infinite. So that's a one alternative strategy, right? And then what would be other ones?
Sure.
So
Yeah. Well, so again, that was just the background of how I got started. So again, that was the first property. I ended up like a year and a half after that, I got a couple more fourplexes, this time out of state in Arkansas. And my plan at that point was always, I had planned to just continue buying fourplexes was my goal, because I could get them, with great, great leverage, great interest rates, long-term loans.
And that's in Arkansas. That's in Arkansas.
Yeah, the second two are in Arkansas, I bet.
That's very different. So that's kind of in a way, I suppose, for cash flow, because that's in a way like diametrically opposite to Idaho in terms of appreciation, I would say.
Yeah,
so it's something really appreciated, and in Arkansas, well, not that much. So,
yeah, exactly. Yeah.
Sure.
But and again, these are ones that were on paper definitely cash flowed more than they actually do. Again, not understanding quite the tenant base and how, I guess the common renters there operate that's compared to Idaho. But overall, though, I never complained necessarily about those properties not being as great as I thought they were going to be, because those kind of what led me getting into the commercial stuff I'm doing now. Again, not going to say was not intentional, but just kind of coincidences, I guess, that came up. So I through that property and the more like the agent there put me in contact with some opportunities to get some commercial land that could be easily flipped for a lot more. So I got this land under contract, and then went out and found some partners to bring in the cash to do it. And the intention was to flip it for about 3 times the initial purchase price. And of course, our plan was to sell it in we were going to sell it a year later for long-term gains, which that 1 year later was 2020, which of course didn't quite work out. We held on to it and are now at the point where we're now got it listed for sale, but we're also considering maybe just build on ourselves. But again, this was not necessarily going to these alternative assets things, but just something that came up.
But that's just if you go on that strategy, let's say in that case, for example, with the land, so is it in completely unimproved state and it's just like really discounted happens to be, or is it you actually then obtain maybe a set of permits that then
so this was a unique opportunity because the land itself was already undervalued. Like, I guess the owner was this guy that just owned a lot of land in the area for many years, and he was just now getting rid of it. These were not listed on any MLS or anything. So they were only going through his agent that was pretty much just putting them out to people he knew, because the price this guy wanted to get for me, like he didn't really know or care what the actual value was. He was just willing to let it go for essentially half of what the value was at that time. So the guy that the agent that was putting these out there for who wanted to buy them wasn't even taking any commission on those on the sale of those lots, because he knew that he would get on the back end later on when people would have flipped them or do whatever. So in my case, this was land. So I was able to get into it with zero money out of pocket. It's just one of those deals that, I got it under contract, and then found people that saw the value in as well, that were able to bring the cash. So we purchased it in cash, with again zero down from me. And so when it does, if we sell the land as it is, like the original plan was, we'll each walk away from there with a decent high six-figure number from that. Again, free for putting zero into it. That's pretty good. But so that was part of the plan was if we sold that land, I was going to take that cash and then reinvest it into something else.
But your investment was zero, but you still walk away with high six-figure
Exactly.
investment.
Yeah.
How is that? So you have like pretty high like profit split, or like how does that work?
Yeah. So the guys that brought the cash to put the cash down on it, of course they'll get paid back their capital, but then any gains from there, we have it split. So there's three of us, so the gains would be split three ways. So they were fair with under the understanding that since I got the property under contract and brought them the opportunity, they were willing to give up that equity for the chance to get something out of it. And the reason this was so valuable is this area was about to explode. This is like literally right before. This entire area is now under huge development, like a brand new high school is going up, a huge assisted living center right next to it, a bunch of businesses and other things going on there. So lots of things that were happening that we understood were coming down the road. From when we bought it, there was nothing else around there, but these things were in process to happen later on. So that was part of what made it so valuable. But so from there, technically I'll say the alternative investments we're here talking about though isn't even so much of that. So again, going back to what traditional, I guess, people are doing for investing in real estate is, obviously single families or Airbnb, short-term rentals, or in the most case of private people here is more of a multifamily, apartment buildings. So for me, over the last, say, couple of years or so, I've been working to get more into that aspect of it for the commercial side of multifamily, but I've not been satisfied with the returns I'm seeing in most cases, right? The prices have gone up extremely high to purchase them, almost to the point where it makes like almost no sense to buy them, because there's very little reward for high risk, with what's going on in there. And so I've been diligently searching for something I could either purchase myself, again, like just even the fourplexes, or like a smaller, medium size, like a 20 or 30 unit I could do with like a JV deal, or something bigger that I could syndicate with several sponsors that could do it.
Where you're saying in Idaho prices have become very high, or in other places?
Everywhere. Honestly, it's so I've, of course, in Idaho, I've been myself searching, and we've bid on several things. Always get outbid usually. But just pretty much anywhere, I've been looking, that'd be Idaho, Arkansas, Texas, Alabama, Florida, just about anywhere. When I run the numbers, I'm like, they don't satisfy me. They'll still cash flow. I'm not saying that there's nothing that's going to cash flow, but for the returns I'm used to, or what I want to get, like, from that, even that very first property and the other ones that I've purchased or been involved with, I'm used to getting, very high returns. Generally, especially putting in a low down payment helps you get a higher cash on cash return. So I'm used to getting like a 40 to 60% cash on cash.
Exactly. Right.
And so which is pretty good. So when I see like 8 to 10%, I'm like, yeah, it's not really great, So so I'm patient and just wait. And I know there's
40,
something to come up.
Because I'm kind of I get that, like the 40-60%, but just for our audience. So that's under which leverage? Under the 10x leverage, or under the
under so again, that first one I bought here was a 10% down payment. So
so that
was definitely giving me a higher cash.
Yeah.
The two I bought in Arkansas, I got with a 15% down. So those were still like around 30 something like that. So
makes sense.
So so when I try to run my numbers, I try to always analyze it with a lower down payment, just knowing or assuming that I can get either 10, 15, or something around there. If I can get to work at that, then great. If I have to put more down, we'll see. But I try to find options to put as little down as possible, just so I could therefore have more funds to invest in multiple opportunities, right? Instead of putting 100,000 down on one property, if I could divide that into put to 3 or something, then allows me to get more properties, which is even better. So again, so sorry.
Sorry to interrupt. So high level. So initially, it sounds like your strategy initially was more. Let's say, were you focusing more on the cash on cash returns, like kind of like the leverage thing, or were you focusing more on? Okay, you want to kind of have an equity gain, and then if that or was and that equity gain via either was it via appreciation more, or was it okay? You want to just find something discounted? Because I know, like let's say, like then I'm sure you're going to go in the commercial side, and I know people in the commercial side, they really promote like cash flow and economies of scale, but I feel like those are exactly the variables that are efficiently priced. Then I don't think they're useful. I think what's useful is levering those into like an equity gain. And that's pretty much what every operator kind of intuitively has discovered and what they do.
Yeah.
So, but
so exactly. So again, for me initially, my goal was the cash flow. I didn't care about the appreciation. I was like, if it came, great. If it didn't, I don't care. I'm here for the cash flow, because that was my initial goal, because I was trying to get to that financial independence number, and that is supported from the income. So the income was my goal. I did not have any plans at any time to refinance or sell or whatever, other than maybe do a 1031 something bigger at some point. But it was always about the cash flow, because I was trying to get that income to offset my W-2 income. So that was always been my goal from the very beginning, and even now it still is mostly that. Of course, this is going back into 2017, 18, kind of before everything exploded with the prices going up with appreciation. So I was never counting on the appreciation to happen.
Well, it exploded in Idaho. It didn't explode.
Yeah, it did. Which looking back, I regret several others that I passed on because they didn't quite meet my numbers. But whatever, it's fine. But anyway, so going back, so I again going after the cash flows primarily, and even before I get into the stuff with the RV campgrounds, going back to that land lot that we're flipping, I went back to that agent, asked if there was any other lots available there that we could purchase. And there was a smaller one down the road that I was like, okay, let's get that under contract. Kind of did the similar thing. I got under contract, found a partner, but this one I had the idea that I didn't want to just flip this down. I wanted to build on it. I wanted to get something put there that will cash flow with a lower cost overall, because we're building it. And so looking at initially I was planning on doing something with like say some nice townhomes there. But in talking with the agent, he said there's a huge demand and need for commercial space. So I was like, I never even thought about that before. I know people do pretty good with like triple net leases and things. So I was like, well, let's compare it. So I kind of ran estimates on what it's going to cost to build them, what's going to cost to operate them with expenses, and overall the numbers looked like they would work out way better with the commercial building. So again, I got a partner, and then so we've got that now in process. We're going to build a 5-unit strip mall on this other lot down the road. So the overall cost to build it is going to be maybe a little bit less than what it would cost to build some townhomes. And the cash flows are probably about more or less about the same, actually a little bit higher, but the overall expenses are much lower, because these businesses are going to be paying a lot of those expenses themselves rather than us or the tenants, and then of course a lot less worry with tenant turnover or destruction of property and that kind of stuff we deal with traditional renters, right? So we're in process to do that, and again, based on just those numbers alone, what we expected the cash flow at once it's fully filled and operating. That alone is going to get me to that additional number I was trying to get to with my cash flows. But on that one, of course, it has that equity multiple coming down. So it's going to cost us all in, including the land and the construction costs. We'll probably be all in right about 1.3 million total. But once it's done and operating, we expect it to be valued at probably 3.5 million maybe. So therefore, at least a year or so down the road, once it's all built and operating, of course, we'll do a refinance to pull back our initial capital and still have that property, cash flowing. So that one is
a huge upside. Yeah, that's pretty,
this one
pretty impressive. Yeah. Uh-huh.
Yeah, this one I was like, this is pretty cool. And again, it's one of those things that's kind of takes some risk, because neither myself or my partners had ever done anything with construction development or even commercial properties. so it's something new, but we were all willing to take that.
Sorry, that's ground up
ground up.
Or?
Yep. Yeah. So
how did you come up, let's say, with that specific strategy, given the subsequent spread that is so high, that is pretty nice.
Yeah.
Right?
So
How you want to
we
guide us through
again
that?
we got some. We first, of course, had the architects or engineers or whoever to survey the lot itself and kind of see what's going to fit there. What's the biggest building we could fit with the parking requirements and everything else. We're initially thinking maybe a 4 or up to a 6 unit. We'll end up settling on 5 was what fit their best to have the good size units there with the drive-through on it, in case one of the end units could be a restaurant or a pharmacy or something. And so so we of course get some estimates of what's the rents are going to be for commercial spaces, for what's already going on in the area, what people would pay for this specific location, because this location is like a very hot area right now, and people want to come there. So even before we even started building, just as soon as word of mouth got out in the city offices that something's going to be built there, we already had businesses contacting us, asking to get a lease there, and we're like, well, we don't even know we're going to build yet. so again, to give you any numbers just yet, but we'll keep it on their list. So anyway, so we understood that. So this was kind of our proof of concept. There is a demand there, and these will get filled up pretty easily. So anyway, so we're in process on that. Hopefully, going to be breaking ground here in this summer.
Just again, sorry, just for my understanding, I get kind of curious about that. So basically, there's like a pretty huge discrepancy between the cost to build and the NOI evaluation.
Yeah.
And that's kind of what's driving it.
Yeah, and of course those costs have gone up over the last year as well, but they still fit within that frame to make it work.
Yeah, because I guess it's very high NOI for those commercial spaces happens to be, but still, that's a huge multiple there, actually.
Yeah, for sure. Yeah, and so, but again, even without the equity multiple and planning to refinance it, just looking at the cash flow we expect to get from it, for me, it was enough to say, this is definitely worth going after to make this happen. Because if we can get even our mid-range estimates on what we think it's going to cash flow at, that this would be amazing. So we're all like, let's get it done and make it happen. So we've been working on that.
But the initial invested capital, the 1.3, right? That one, do you do hard money lend or whichever bridge financing of sort or so forth, or is it more cash, or you also borrow that?
Right. So that total cost is going to be mostly just from a construction loan. We had some capital we put up front to purchase the land initially, but the bulk of that is going to be the construction loan. And then once it's done, then we refinance out of the construction to a long-term debt on there. So
how did you find the deal? How do you find the deal? You were just looking for land in commercial land in
again, this was
land, essentially.
This was because that the other lot that we already had that we're planning to flip. I asked the agent if there were any more lots available still that we could do something with. And again, not necessarily planning to flip it, but that's always again the fallback plan is if this doesn't quite work out, we can always still go back and resell the land for more anyway. But the initial plan was always wanted to build something there because we knew we wanted to get that higher cash flow, not just a decent bump in a quick cash return for selling it. It's kind of more of the long-term play. Myself and the partners involved wanted to have something that cash flows now, but at the same time will be more like a generational wealth type thing that we'll hold for long-term to get the cash flow plus the equity gain at some point, and we could refinance it a few times as we needed to over time. But so going back then to the other part with so that's one of the alternative strategies is new construction, right? So
and just to give a perspective, again, sorry to interrupt again, John, just to give a perspective, so that's that's more than 8 times multiple, I presume, on raising the valuation 3 times or so compared to
probably. I mean, we bought on this one we're going to build, and we bought the lot for I think 240,000. And it's the total construction cost, at least the last estimate we got, is going to be about around $1 million, just under $1 million. So, but
so that's borrowed, so that's kind of
right. Yeah, exactly. So all out. We don't, not quite sure what we've got a good amount of capital for one of our partners for operating expenses and to pay those what's due on the draws for the construction along the way. But even then, we figure all out of pocket will still be probably under $300,000 or so total out of pocket by that point. Again, because the construction loan is going to use the value of the land itself as the down payment, virtually. So, so that kind of covers a lot of our expense. So that's why all in, we're right around at 1.3. But compared to other buildings in the area, similar properties and what they're selling for, we know that ours should be worth at least 3.5, if not more, by the time it's done.
So,
So,
hey,
Nelson has a question. Yeah.
yeah, and Stefan, thank you, and Stefan, as always, thank you for bringing in these great guests. Don, first of all, thank you for being here. I wanted to ask you on the construction. Okay, quite frankly, I'm always scared of construction and development.
Yeah.
Two questions. One, what's the thought as inflation comes in and rates go up? Because these properties are the residential housing, correct? Did I miss that?
For the construction, no, it's a commercial property. So a triple net lease, like think of like a strip mall place is what it is.
Okay, all right. So as we go into, interest rates going up, what's the plan for that? I mean, I would think it might be more difficult on that side.
It's for, you mean like for the loan for it? You're referring
Well,
to, or what?
on the exit, on what one is on the exit, are you guys going to hold on to it, or are you going to sell it?
Yeah, no, we plan to hold it. Yeah, we're gonna hold it. As soon as it's done, the actual construction, then we'll refinance the whole thing into a long-term loan at that point. I mean, we pretty much have to basically just roll over the construction loan into a long-term loan. Then the plan would be in about a year or two, then at that point, refinance to pull cash back out.
Okay, so, I mean, do you already have tenants?
We have, well, since it's not built yet,
is there a plan that
we've got some LOIs from the potential tenants that want to get the space there. But of course, until it's actually built, we're not signing any actual long-term leases yet.
Okay, because my thought is, we're going into a higher interest rate environment.
Yeah.
It's going to be difficult for some businesses to expand, to get going. So there's that side, and we're still on the upside of the real estate market cycle. What's the plan when we have this side of the cycle? The opposite side of the growth cycle.
Sure. Well, so for us, we're any business applicants that come in, of course, we want to verify that they've been in business for a while, that they're strong tenants, that will have no problem paying the lease if any downsides come up or whatever. So that's kind of more of our I guess way around that risk is just getting some strong tenants that have, preferably national chains or something that have that the strong financial balance sheet that, no matter what comes up, they'll be able to pay their lease without any problem. So we're not taking like brand new startup, mom and pop place that's doing their first business ever. That'd be too risky for us to take on for that.
And this is a strip center.
Yes.
Okay, so in a strip center, can you kind of give an idea of? And again, I don't know Iowa. I don't know the Midwest. I've always wanted to go because I think the scenery is really nice. But what kind of a tenant would that be to come in a strip center that kind of has that financial weight?
So this is in Arkansas again, but it's where it's located is right next to a very high end housing development that's going up like literally right behind it. So the type of tenants we want in that space are more like, think of like professional offices like CPA, attorneys, financial advisors. That type of tenant was what we're ideally looking for.
Like an A.G. Edwards kind of thing.
Yeah, exactly.
Okay, all right. Thank you.
Yeah.
Thank you. And by the way, what are you raising capital, anything at all? It seems like it was almost self-funded here.
Yeah, this was just as a purely JV deal with me and two other partners. Self-funding it from purchasing the land and then paying for the the construction draws along the way. Again, we're getting a construction loan to pay for that. So overall, very little out of pocket, I guess, for the overall cost of the whole thing.
Okay. Well, thank you.
Yeah.
Thank you. It sounds like a perfect timing move. Timing.
Yeah. Well, it probably would have been better if we could have gotten it done, a little bit sooner, but right before all the supply chain issues. But so as of right now, we haven't broken ground yet, so we'll see how that affects us if we can get it done in time as planned. But we'd actually had planned to do it earlier last year, but had some issues with the lenders we were working with, and some things we didn't expect. Again, none of us had ever done construction before, so we weren't fully aware of the whole process. And but we were willing to give it a try and figure it out along the way. We figured, it can't be that complicated. So we've had our agent there who's done development before, so he was helping us out. The builder we were working with and the architects we were working with, we explained to all of them that we've never done this before, so we definitely need some hand holding along the way, and they've all been very gracious and helpful to make it not so complicated for us. So it's been a good process overall so far.
Okay. And by the way, just out of curiosity, what kind of lending questions that they have that were curveballs?
Well, so part of the problem initially with some of the lenders we spoke with in that area, and this is kind of common for commercial loans, I guess, at least in that area. I've ran into this before in Memphis as well, is many of the banks there are, especially in the local small regional banks there, they don't necessarily like giving out commercial loans to people that don't live in the area or have any connection to the area. So since neither myself or my partners are from that area or had any history there, I guess they were not necessarily willing to even lend to us for that reason. Several of the banks. So it took calling multiple banks before we found some that even would work with us. And then initially with the very first one we tried to work with, we figured, okay, they said, yeah, we'd love to fund this, no problem at all. We gave our business plan and everything we expect for our projections. Got the architects to give us the designs and everything, which of course also costs a lot more than we initially thought it would cost. And so we gave it all back to the banks. Like, here we go, we're ready to go. Let's get this loan funded. So we start building. And that's of course when we found out that they expected to have the LOIs from the tenants first, which they didn't tell us that ahead of time. So so we didn't know that. So then we had to go back and try to get these LOIs from these tenants. And by this point we were like, fall of last year, close to Christmas time and stuff. So all the holidays coming up. So it was difficult to get that. And some of the businesses were trying to get LOIs to that point. Not necessarily we'll take them as a tenant, but just to get the LOI to get the bank loan. Several of these businesses weren't even willing to sign an LOI without knowing there's going to be a building coming there, because there's been several others that have I guess promised to build something, but then end up not doing it. So they were not as willing to sign, even though it's just an LOI. It's like it's not any type of long-term contract or guarantee. You can still get out of it. We have even wording in there that they can back out. But even with that, people weren't as willing to just sign something feeling like they're signing a contract without knowing for sure that something's going to come there. So that was an issue we had to get through as well. And we finally at this point we've got everything we need. We're working with a different lender now. Actually, they're going to be meeting this tomorrow, I guess, to meet with their committee to discuss getting the loan approved.
So, a question actually we got in the chat. So from Siva, so what are the acquisition cap rates and exit cap rates, let's say, for some of the projects we are discussing, I guess? I mean, we discussed few different ones, but
yeah. So with this construction one, I'm just trying to, I don't have these numbers off my head right now, but I think our initial purchase cap rate, I want to say we're, man, I can't even, I don't know if I can even guess here. I don't have the top of my head. I know that looking at the cash on cash was again expected to be around 20 to 30%. So I think our let's say purchase cap rate once it's all built and funded is around that 20% maybe, somewhere there. I can't remember quite exactly. Yeah, and then of course the exit point would be
you mean at your invested capital, sort of like
yeah
okay which is like it just has a huge upside basically, right?
Exactly.
And then the exit one is like 6.5 or something, right?
Yeah, something like that. Yeah.
Sure.
But again, the plan is to hold it long term anyway. Unless at some point it makes sense to sell it for different reason, to build something bigger. I don't know, but we plan to hold it long term for the cash flow and do the cash out refinance and pull all of our and hopefully more of our initial investment out, and just still hold it after that for long term for cash flows. So, so again, this was kind of a scary jump for all of us because we never done it before, but it was worth the risk, worth the effort to try to do, because we saw the returns that's going to come from it. And that actually sort of from that led me to getting into another team that I'm with that actually does new development of multifamily. So I got involved with a team here in Idaho that's
sorry,
building
John, so just sorry to interrupt. So when you say like all these partners so far, so did you find them like online? Because I know like you're active on social media and that, or
Right.
did you find, or what? How
Yeah,
did you
well,
find your partner?
at this point, I actually was not active on social media other than Bigger
Okay, not
Pockets.
yet. Okay.
So the partners for the land flip came through Bigger Pockets, actually. Some that I had reached out to from there, and he was actually in that area in Arkansas, so it made sense to contact him. He does a lot of house flips out there. So I got a hold of him first. He liked it. He knew the area. He understood what was going on, and then reached out to his investment pool to get that funding to purchase it. The construction deal kind of came up again. Being my wife is a realtor here. One of her previous clients, who and again, a lot of her clients come through Bigger Pockets through me, so I kind of filter through a lot of them and send them over to her. This is someone that contacted me on Bigger Pockets several years ago about purchasing something here in Idaho, and in discussions with him previously, I kind of knew his risk tolerance and what he was looking to do and what he could potentially do. So when this opportunity to do this construction deal came up, I actually contacted him first just to see if he would be interested in doing it, and he liked the idea and he was on board with it, and he said, "Yeah, let's do it." He had the capital to help make it happen, and so it was just initially him and I that first bought the lot and started all the process with all the architects and everything else, and then just recently, beginning of this year, we actually brought on a third partner, just to have additional liquidity and higher net worth total, to make it more enticing for the banks to lend to us. And he therefore brought another good chunk of cash to have, like, just in an account that we can use for that, for those construction payments along the way, and just to show the bank, hey, we've got this money sitting in the bank ready to go, in addition to our total net worth between three of us now. So that would just recently came on as a new change for us, because we decided it'd be worth doing to have a third partner that has that liquidity to make it a smoother process overall for everybody. So yeah, so they all came from previous networking, not necessarily online.
Yes.
Just yet to this point.
Got it. Yeah. So another question, from Viraj Chopra. So he's asking, what is the best way to get into construction without having any prior experience with construction? Is first question. And second, how to make sure we're covering everything with construction contracts, no surprises once construction is completed.
Yeah. So, I mean, I definitely would not suggest doing it the way I did it. It would probably make more sense to have a partner that has experience with that knows what to expect. For me personally, I made several contacts along the way with people that have done lots of construction and was able to ask them questions. They weren't necessarily partners on this, but I was able to say, hey, what do you do about this or this? What does this mean? So that helped me quite a bit. And then again, in my case, we kind of, I guess, lucked out that the builder we're working with, the architects we're working with, and even our agent there, all are of course knowledgeable in the process, especially of course the builder, and we explained to them that we've never done this before. We really don't know what we're doing, so we need their help and guidance to make sure we don't mess up, and we take their suggestions. If something came up like, hey, what do you think about this or this? I said, well, what would you do? And we've had enough communication between all of us that we feel comfortable and we trust them with their opinions and suggestions. So that's just, for us, it's worked out in that way, just finding great, essentially they are your partners as well. The builder and the architects, everybody involved should be considered your partners, really, because you're relying heavily on them, especially in this case for us. None of us are there local to monitor what they're doing, so our agent is more or less acting as part of our extended partner on that as well. In fact, he's going to be renting one of the spaces in this building. So for us, it was just more of that. If you can find a great partner that's had experience, that knows what they're doing, that'd be ideal. And if not, at least have some contacts with people that you can at least ask questions to, and and I guess above all, trust your builder.
Mhm.
You know, get some referrals
So-
if you can, from people that have used them, preferably.
Mhm. So would you like to talk more, about Happy Camper
Yes,
Capital as
definitely.
well?
That's
So what do you
yeah.
guys
Let's get into that.
do there? Yeah, yeah, sure.
So so as I was trying to get to it before, as I was
Good.
looking through multifamily and trying to find something in multifamily to invest in, even as just as an LP myself, I looked at probably at least a couple dozen different syndication deals over the last year or so, and again, me being used to these numbers I'm seeing and everything else I've been doing, I'm like, I'm not satisfied with an 8% return or even less sometimes, and
Yes.
some cases, like a 1.5 multiple, and I'm like, yeah, really, that's not even,
Yeah.
that's not really getting out of bed for. And so I was like, there gotta be something better. I just kept being patient. I did not want to just put my money into a deal just because, just having a deal, which I feel lots of people have been doing. In fact, I've talked to people that said, yeah, that's pretty much the reason why they're anxious to get into a deal, and that's all they see. So they're figured, might as well. It's better than nothing. But I've been more patient with that. Again, kind of going back to where I started from with very little savings, almost practically broke. I was very particular and patient and precise with what I would invest in to make sure I get the highest return possible from my investment. And so about a year ago or so, I heard on a podcast someone mentioning campgrounds, and being where I'm at in Idaho, again, I'm like an hour and a half away from Yellowstone Park. All of my neighbors have campers and RVs. So this was something I'd never even considered before. I didn't even know it was an investment option. So I started going to webinars and meetup events with people discussing campground investing. Initially, basically just to learn, obviously, and two, I was offering to be a boots on the ground. It's like, if somebody wants to buy here, I can go check it out for you, take videos. My wife can help with the purchase. That was pretty much my initial, my trying to get my way into something. And in doing that, is going to these meetups. I met a couple guys that had recently started a company called Happy Camper Capital, and we talked about what they were looking to do and what I was looking to do, and and I saw, again, going back to that initial podcast I heard, the kinds of returns they were getting. I'm like, this seems kind of too good to be true. And I talked to these guys at Happy Camper Capital, and we discussed how this all works, and it just kind of, for me, I was like, wow, this is an amazing opportunity. And if you want to compare it to something, if you look back at, say, like mobile home parks or self-storage, which a lot of people are doing now too, just about as much as multifamily. 5 years ago, nobody was doing those. And it wasn't until they started to get talked about, like on Bigger Pockets or other places, where people say, oh, let's buy mobile home parks. And that's really what got everybody else involved and made it become crazy. So 5 years ago, they were probably getting excellent returns. Now they're about average returns about anything else. But so with these campgrounds, it's kind of a newer niche that there's not a lot of people doing it yet, but more people are getting involved. But as of right now, we are getting these properties for averaging probably around a 10 cap purchase price. And if you think about it, like you'd mentioned at the very beginning, something about short-term rentals, so what these campgrounds are initially is essentially, I'd say, are short-term rentals on a multifamily scale. So we're able to get these campgrounds with, say, 100 to 200 or more, RV pad sites. People come, stay there, a weekend, a week, a month, however time they want to stay, and then they leave. So there's no tenant contracts, eviction moratoriums. We're not, changing carpets and painting properties. So a lot less overall oversight, but getting high returns. So again, kind of comparing the short-term rental, if you want to compare short-term rental to a standard long-term rental, single family, your short-term rental is generally going to get much higher returns. And that's what we're doing with these properties. We're getting much higher returns than we do with a standard, say, multifamily of the same size. And so for me, that's what really attracted me to it. I was like, wow, if I can get, and say our average deal, we're looking at about a 15 to 20% cash on cash with about a 3x multiple, right? So if you want to look at the multiple side, you're getting a 3x multiple as compared to 1.5 to 2 as in most multifamilies. So right there alone, you're getting much higher returns. But also on the cash flows, we're getting at least double or more of what standard cash flow from a multifamily property is as well.
Right.
So I'm getting the high cash flows and a high equity. Yes, standard holds for 5 years. Yep. And so for me, again, if I try to, as just an investor, I'm like, okay, if I've only got, say, X amount of money to invest, but I know I wanted to get to a certain point of cash flow. My goal is financial independence from the cash flows, not necessarily from the equity multiples. I was like, I can invest in 1, 2, maybe 3 of these campground properties and get that number instead of investing in, say, 5, 6, or 7 multifamilies. to get that same amount of cash flow. So for less money out of pocket, less deals to keep track of, and then on the end, I'm getting a much higher equity multiple as well. So overall, it just,
And that's,
for me,
and
much
so
better.
Are some of those JV or are they syndications? Or
And these are all syndications. Yep.
they're all syndications.
Yep.
And so the multiples, are they after the like after the GP split, like after all fees?
Yes.
Or are they...
Yes, exactly. So these are all value add deals similar to a multifamily, but just like you said, different triggers, or different ways to get there. They have multiple income streams. So it's not just standard just from the rent alone. There's other income streams from these properties, that of different amenities that people use, and even people that are not there necessarily camping that come there for different things, for events going on. Some of these could have like a concert event on them. If there's like a lake or a river, there's a lot of different water features that people could come there and use and have fun with. And of course, glamping is a big part of it. We have on-site cabins or trailers that are there just for this purpose of this glamping experience. People can come there like a short-term rental, and get their Instagram pictures and have some fun and leave. So all these different multiple revenue streams together is what produces much higher income. And then over time, again, we're based on, it's still a commercial property. We're basing on the operating income, so we can improve those processes through better software management and other just overall management processes to reduce the expenses and of course increase the income through all these other aspects besides just the rent increases. And therefore that equity multiple gets of course increased along with that as well at our exit point in 5 years. So that's kind of where we're getting these higher returns and high equities.
Yeah, that kind of makes sense. So how do you find your deals? Let's say there, like, how do you, like, just agents? There are agents who deal specifically with campgrounds, or like, and that's their focus, or how does it work?
So we get deal sources from both agents, brokers, and direct to seller. So I'd say it's probably about half and half. I don't know if there's any, say, brokers that specialize in just campgrounds, because they probably wouldn't have enough business to keep them busy. But there's several that will put them out there, and we get them through there. But generally, what we try to do is, of course, go directly to the owner. There's basically say a directory of campgrounds called Good Sam, which is where people use to find campgrounds anyway, where they want to go and stay. So we use that same directory to find out who's the campground owner, talk to them directly, and see if they're wanting to sell. And the good thing for us, we have a sister company. So it's part of our management. We have a separate entity called Beyonder Camp that does the campground management. So when we talk to a owner, if they're not willing to or ready to sell right now, we at least offer if they want to have us take over the management for them to help them free up their personal time, to more or less be somewhat hands off on their own property, because a lot of these places are owner operated. They're there probably doing the job of 5 or 6 people. So if we can free them of their time, they might like that. So, and then of course, if we manage it down the road, we can later be the first line to buy it. So we're calling the direct to the owners, but we're also taking leads from any brokers if they come up.
Got it. And question on the chat from Siva. So what are the typical insurance costs?
Yeah, well, it's going to depend on, of course, the property and the location. They're going to be generally probably a little bit higher than a multifamily property, but again, it's not to the extent where it doesn't make sense, because the income again more than offsets that. But you'd probably get, depending where it's at, it's going to make a difference. Obviously, something in Florida is going to be higher insurance just because of hurricane risks or other flood risks, as opposed to something in, like, say, Minnesota or something. But so it's going to vary across the board, but it is typically going to be probably higher than what you see on a standard multifamily.
Mm-hmm. Do you guys have a project right now, or like that people can invest in? Just curious.
Well, yeah, we've got several that are in the works. We've got one we're closing on like this week. Another one coming up. We do both 506Bs and 506Cs. So a couple of our 506Bs I can't really talk about right here, but we have several coming up. But again, we try to make it as available to everybody as we can. Our goal this year is to close on at least 12 properties. So we have lots of deal flow coming through. So there'll be multiple opportunities for anybody that wants to get involved. And of course, the main suggestion I would say is go to our website. You see by me here, happycampercapital.com. register on the investors profile there. That way you'll get access to see any current deals as they come up, and you'll be alerted to any new deals when they come into the portal as well. And we do several webinars, not just on the campground sites themselves, like just to do a webinar for the property, but we do other like educational webinars as well, to kind of help educate our investors just about everything, not just campgrounds, but we recently had a guy that talked about some tax deferral options outside of a 1031. We're looking at have some other people come on about different things as well, just overall tax strategies or ways to manage your funds.
And so you're saying, so they're all over the country, really, like the campground?
Yes,
right?
exactly. Yeah, we're not restricted to any specific state or region. And there's, again, from other people I know that are in the space, some that do focus on, say, just the Southeast or different areas, but we look across the country. Our main criteria is it's got to be within about a 2 or 3 hour drive of a major city, of growing population city, and at least 100 existing RV pad sites, preferably with room to expand. That's one of our criteria. Almost every property we buy, we want to expand it, add on more sites, add on more features. But the reason to have that location to be close to a big city is primarily for the built-in user base. So, if gas prices continue to go up like they have been, people are less likely to take cross-country trips. So, but again, people that own campers and RVs, they still want to get out and use them. So they're willing to take that short drive of a couple hours to get out to one of these places and just, go there and have fun. Use their campers, because they're quite pricey. The really nice ones are very expensive. So to be, they don't want to have them just sitting there in the drive. They want to get out and use them and have fun. So, and as of right now, there's way more existing campers and RVs out there than there are campsites for them. So if everybody on the same weekend decided to go camping, there would not be space for everybody. As of right now, the current manufacturers of campers and RVs are behind schedule. They're trying to catch up with last year's orders still. So there's a huge demand for these spaces right now. And again, part of that, besides just the standard people wanting to have them and go out and have something to do, but millennials are actually the largest purchasers of new campers and RVs. And part of that, I think, is twofold. One, that they're being priced out of houses. Right? They can't even buy a house right now. But two, if they're because of COVID, many businesses have allowed their workers to work remotely. So even if I look at this, if I was the same situation, I would do this too. But if you're not tied down to a specific place, like you don't have responsibilities, like no kids or whatever, that you have to be in a certain area, it's like, why would you want to be stuck in the same city for years? If you have the opportunity to travel and live someplace different every week or month, then why not take that adventure and do it while you can? So I think a lot of, and that's, again, you look at Instagram or YouTube, whatever, that's a big thing right now, is this whole, RV life or van life following. So people are out there doing that, and they're coming to these types of campgrounds because they're not just there to camp. They want those other amenities, right? The cool, fun things to do that while they're there, and of course the strong Wi-Fi we have at these locations as well, so they can work from there, and then at the same time have fun and do things. And they're close enough to a big city; they can go there and have fun there too. So, so we cater to those types of people, besides just the standard, family campers or seasonal people that are getting away from, they become snowbirds. People get them from the north to south, vice versa, during winter, summer. So we cater to everybody.
Got it. And so your direct to owner strategy, let's say, in something like this, so that is kind of a little bit like short-term rentals in a way, right? So they need to promote, so they need to be like at Good Sound, like you're saying, or other places. So is it that essentially that kind of saves you money on, the direct mail, because now you can just reach to them directly on that platform?
Yeah, pretty much. That's a good point. Yeah, we don't really send too much letters out. It's more just directly calling them.
Right.
The good thing is, a lot of these places, traditionally have been purchased between just private sales. So one owner buys it from another seller, not on open market, not on any kind of thing. So the prices have historically been much lower for that reason. So in the last few years, where there's been more now institutional buyers that have, of course, brought their prices up. So even like a couple years ago, when Happy Camper started, they're buying campgrounds at about like a 12 cap or above. Since then, they're now, they were probably close to an 8 to 10 cap. As time goes on, they'll probably be lower. So I'd say right now is for us, is a great time to get in. And then at the point when we are exiting, it'll probably most likely be overcrowded is like everything else is now. And so we'll exit even probably higher than we would expect to.
Mhm. And then what about, so before we're a bit over time, but let's say before we wrap up, so let's say in terms of property management, like what are some, let's say, because in multifamily respectively, I presume property management is more standard than in campgrounds, and given you do it all over the country, so what is your strategy for that? Do you kind of like build a team like on the spot, the moment you have a campground, you just kind of hire people ad hoc and they act as property management, or are there like companies that do it for you? Like what is the approach there?
Yeah, so obviously on site there will always be a campsite manager that's there with staff. So that's one of our, of course, our biggest expenses is going to be this the for staff. So as opposed to multifamily, you don't have just one property manager. We've got our on-site campgrounds manager and then the staff that handles all the operations there. So since these are multiple locations across the country, like I mentioned before, we have our own management company called Beyonder Camp that oversees those managers. So basically, they're acting like as an asset manager to more or less manage those campsite managers. No different than your asset management team on a multifamily would manage the property managers. Kind of similar type of thing. And so we provide, of course, the software is the biggest thing, the software, and then of course the training. So as we purchase the campsite, there's existing staff. We try to keep as many of them on hand as we can. And make that transition to keep it running smoothly, at least at first. And then, of course, monitor them and see their performance and replace as necessary. But preferably if we can, we'd like to keep everybody on staff that's already there. So this whole Beyonder Camp manages all that, and the people we have managing Beyonder have extensive experience and history with hospitality, hotel management, marina management, campsites, that's kind of everything. Because what we do is not say just campgrounds, right? So in many cases we have marinas involved, potentially hotels or other Airbnbs that are on site as well. So there's multiple aspects to manage these. It's not just a standard here's your rent and pay your rent monthly, like a multifamily. So there's a lot more involvement for sure for the oversight of that.
Got it. And so another question like from Carrie is, have you considered ground up construction for campgrounds?
We have, as of right now, it's not in our current plans, and that's just something that absolutely makes sense to do. We do expect to do that further down the road. Again, as the cap rates come down lower, because it'll get to a certain point, kind of like right now with what I'm doing, that it'll make more sense to build it than to buy existing. But for right now, we're just buying existing and do the value add process. But we do have plans at some point down the road. We most likely will get into do some ground up development of the campsites, again, because of right now there is that huge demand for it, and there's not enough spaces to meet the demand as of right now.
Yeah, and so Ranjit is asking, can a sophisticated investor invest with you? Like, or I presume a credit, you mentioned 506C, you guys have that as well, right?
Correct. Yeah, we can cater to everybody, 506Bs and Cs. Each deal will be unique in its own way. We'll decide. It'll most likely depend on the capital raise for it. It will be a C or a B, but there will be, again, we have multiple opportunities, so there will definitely be several opportunities that anybody could get involved.
Great. Okay. Any last questions if you guys have before we wrap up? Nelson?
Yeah. My last question, it was a simple one, Don. If you could just put your contact information in the chat, that'd be great.
Sure. Yeah, I can do that. Obviously, the best way, of course, to go to happycampercapital.com. There's a About Us tab there. It has my personal page there to get my direct link to set up a calendar link with me to set up a time to talk. Of course, my email is here as well, but I'll add those to the chat as well.
Perfect.
All right. Thank you.
And actually, because we got a really good question on the chat, so before we wrap up, so it's actually what are some improvements to increase NOI for camp? Because you mentioned it's different ways that you do, right, compared to multifamily. So what are some of those? So, and is it like mobile home park? So
sure. So no, it's not like mobile home parks. So that's kind of the difference that we tell lots of people here is that besides so mobile home park is kind of almost more just like a standard multifamily in a way, other than you're renting the lot space rather than the units per se. unless of course you own the mobile homes as well. But yeah, these are more, it's considered hospitality. So it's kind of probably more similar to a hotel in that sense. It's a resort style. So we're not necessarily even looking at standard campgrounds. We're looking at resorts. These are destination campgrounds where you're going to for a purpose. You're not going there just to camp and have a campfire and sleep overnight. These are more places you want to go to because you want to go have fun. So either we're going to be near a destination place, or this is the destination. So there will be, again, like water features, concert events potentially, multiple different things we can do. So some of the value adds that we do, like some of the basics, the simplest one we do is first of all, just get them better online presence. Again, many of these places have been mom and pop owned for years, even decades. So they've not done a lot to keep them modernized or even have online reservations. A lot of these places, they only do phone call reservations, and they have like a set standard flat fee. So that way anybody calls up any time of the year, they can say, yeah, it's this much per night. And so for us is to get that online presence, number one, because if for people these days, you don't want to make phone calls. If you can't make an online reservation, they'll find the next one that will. So we get them online with those reservations, make it easy to find. And then we also therefore include dynamic pricing. So as the campsites get more filled up, those remaining spots will go up in price, very similar to what hotels do anyway. So that's great, of course, for high vacation times of the year. Our goal is honestly to never have a campsite be 100% filled. If it's 100% filled, either we're charging too low, or at least with that dynamic pricing, we're maximizing the rent from that. So that's number one thing. Just doing that alone with online reservations generally will increase the income by at least 5%, if not more.
So just to interrupt there, because Lacey is asking a question exactly on that. So like what, well, I guess you're responding to the occupancy question, right, Don, or just making sure. What is then the average occupancy that you typically have in that case, or that you plan for? Because it's not 100 to your point. So is it like 80% or 90 or? Yeah.
So generally we try to, at least when we underwrite them, we look for about 80% is about what we prefer. 80 to 90 would be good. We of course can still cash flow and meet our needs below that, but generally, we want to be probably more like around the 85 to 90 is what we're generally shooting for. But of course, if we get 100%, then again with that dynamic pricing, we're able to maximize the returns as much as possible on that.
Got it. And is there a minimum return on investment that you guys offer, or just target returns, right?
Yeah, well, generally for every one of our deals, we'll have at least the pref return. That's pretty much a requirement. So we generally always shoot for an 8% pref, but in just about every case, we're going to outdo that anyway. It's kind of the standard thing, just to have it there. But again, like most of our deals, we're targeting generally between the 15 and 20% cash and cash, what we're generally shooting for on most cases. And so again, we look at multiple deals. So we're hand selecting out the ones that are going to meet those numbers and passing anything that doesn't. We're not just grabbing anything that comes up and saying, okay, this will work. We'll make this work. And because we don't want to have those low returns for our investors. We want to get the very best that they can possibly get.
Right, Don. But just to clarify, so that cash on cash, it doesn't get distributed back to investors. Only the pref does. It gets at the end of the project.
So the pref again is there to say at a minimum you're going to get this, but we distribute those returns throughout. So if we're getting a 20-25% cash on cash each year, that amount is getting paid out through the quarterly payments.
So that I see. Got it. Interesting. That's pretty cool. That's great, actually. So yeah, and you mentioned hold period typically 5 years, right?
Yes.
Got it. Okay, great. Well, I think we covered a lot today here, so that's really great. Thanks, Don, for being here. It's a real pleasure to have you and sharing your knowledge with us. And thanks to everyone also for joining us. So again, what's the best way to reach you?
Yeah, so I've got probably several places here on the chat. Also, you can find me on LinkedIn. I'm very active there. Go to happycampercapital.com. Under the About Us tab, you'll see my picture there. You can click with me directly there. Set up a time to talk. We have a one-on-one Zoom or phone call. And then, of course, or by email, you're don.spafford@happycampercapital.com. Yeah, I'll be happy to talk to you guys and answer any more questions you have. I'm sure, again, like most people, even myself, when I started, it's a new area that you're most likely very unfamiliar with and have lots of questions. So I'm happy to answer for you.
Perfect. Thank you so much. And thanks to everyone for joining us today. Have a good night.
No problem. Thank you.